Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. So in our second podcast this week, I had the chance to talk to Chris Clothier, who is the co-chief investment officer of CG Asset Management and one of the portfolio managers for the Capital Gearing Trust, the investment trust that CG Asset Management have been running for many, many years. So, Chris, as we've been saying to everybody I talked to on the podcast, it's been an exciting year so far. A kind of year in which people will want some kind of protection against volatility. I think that's really one of the things that people have been most disturbed by this year. We have seen an extraordinary amount of volatility, much of it Trump-inspired. But first, I'd like to start by giving you a chance to tell me how you see the way that Trump 2.0 has been developing over the last few weeks. What have we learned about that rather, shall we say, chaotic approach to policy management?
Yeah, wow, Jonathan, thank you. That's a great question and frankly quite a difficult one to answer succinctly because, my goodness, so many things have happened. I suppose if I was trying to step back and look at the big picture, what's the difference between Trump 2.0 and Trump 1.0? Well, I would say that in Trump 1.0, he had a series of instincts and tendencies, but that those tendencies were kept rather in check by, quote, the adults in the room. That's to say that a lot of the hires that he made into his administration were actually quite conventional. And whereas this time it's much better organized, and I think, frankly, first time around, he probably didn't think that he was going to win, so he didn't do a great deal of planning and preparation about what he would actually do when he got in. Whereas he's had the Heritage Foundation doing all of the prep work, if you will, and he's surrounded himself by essentially acolytes and believers. And so that's meant that the whole thing that we've seen has just been so much more radical than last time round.
Absolutely. And as a result of that, things have moved very quickly. But also, he's been very quick to run into the, I guess you could call them guardrails that are written into the American Constitution, and had some success in perhaps breaching those, at least briefly. But is it safe to say that now, here we are in the beginning of June, we're kind of 5 months into the administration. When it first happened, when the tariff announcements, for example, happened, everybody got quite alarmed that he was using this old legislation to push these tariffs through. But do you get the sense that the traditional restraints on executive power are beginning to be felt in some areas? Is that a fair assumption, or is he still driving a coach and horses through the conventional way of making policy in the US?
I think it certainly feels like he's trying to drive a coach and horses through it. It's almost as though people had never really imagined what would happen if if the executive branch just ignored the other branches. I didn't study politics A level at school, but I presume that one of the things you do is you study the US Constitution, and the three branches of government and the checks and balances are held up as being these wonderful institutions. And then in turn, I think that among lots of other things, has led to essentially the US enjoying kind of the opposite of a risk premium, a risk discount, if you will, because of the fact that it seemed to have these wonderful guardrails. And I sort of think that there's a slight hint of the emperor's new clothes going on in all of this, which is that once you've seen somebody ignoring the Supreme Court and it not being completely obvious that there are consequences for him ignoring the Supreme Court, you kind of can't unsee that. And so I think it's really interesting. First, as you say, do those institutional guardrails start becoming more effective over time? I guess we'll have to wait and see about that. But then more fundamentally, okay, let's just imagine that we look 4 years hence into a much more conventional American president sitting in the White House. Can we unsee everything that's happened over the last few months? Now, I think it is also true that markets have very short memories for these kind of events, so maybe we can unsee it and just forget that it ever happened. But I feel there's going to be some lingering doubts about all of this. So the idea of America being a shining beacon on the hill on the one hand, and therefore kind of a financial safe haven on the other, I think that's tarnished somewhat and possibly permanently.
What we have seen, of course, is some pushback by the bond market. I think we can say that quite safely. They've been pushed back by the bond market. Interest rates have not come down as many expected, and the chairman of the Fed's been given a bit of a sort of public reprimand, if you like, for not cutting interest rates. But the bond vigilantes, if you like to call them that, they do seem to be out there, and they do seem to be one of the few things, perhaps, that so far has caused Trump to change his mind, or at least temporarily pull back from what he was proposing. And at the same time, we've seen long bond yields going up and the dollar's been falling, which is an unusual combination. So that seems to suggest, as you're implying, that basically the world thinks that whatever they thought about the strength and stability of the US as a financial center, if you like, that's been a little bit eroded at the edges. Would you agree with that?
I absolutely would agree with that. And as you say, I think you hit on completely the right point, which is the fact that generally speaking, in recent years, when the long bond has risen in yield, the dollar has gone up most of the time from certainly the last 10 years. And that has stopped to happen. And really, in April, frankly, we saw the US dollar behaving like an emerging market currency, or alternatively, like sterling does. During our periodic little crises. And it's funny, I was thinking about it because actually, if you look at the 10-year interest rate, has basically unchanged over the last 12 months, sort of around the 4.4, 4.5 mark. But where the action has all been, it's been in the 30-year. And so the 30-year was, I think sort of a year ago, it was probably about 4.5. And then it's risen up to 5 and change. It's now fallen back a bit to kind of 4.85. And why is this happening? Well, fundamentally, it's about the deficit. The deficit is forecast to be 6.5% this year. It's worth remembering what that is in just pounds, shillings, and pence, or rather dollars and cents. It's $1.8 trillion. I mean, it's a truly astronomical sum of money. And I think that one of the things that was keeping long yields in check was also the fact that the market was giving some credence to Scott Bessent, the Treasury Secretary's 3 plus 3 plus 3 mantra, which was that he was going to get GDP growth in the US sustainably to 3%. He was going to get the deficit down to 3, and he was going to increase production of oil by 3 million barrels per day. Now, we always thought that all of those things were pretty fanciful. So just taking the growth point, growth has averaged 2.2% since the turn of the century and has been on a downward trend. And then if you slap on tariffs, 1, and you start deporting people like crazy, 2, that's not going to cause the growth rate to go up. And similarly, there seemed to be no constituency in the Republican Party for reducing spending. But nevertheless, the market seemed to give some kind of credence to that. And then I think that what we've seen over the last month or so is that their faith in that has started to wane.
Indeed. And Trump is pressing ahead with his tax bill or deregulation proposals as well, which he hopes will stimulate growth and help to bring the deficit down. But I guess the markets don't think that's particularly credible. It's going to make the deficit worse, if anything. What do you think, though, about that? In other words, if something's going to give here, what is it going to be? The growth won't hit the target you're suggesting. But what about inflation? Is that going to come into play as well now?
I definitely think that all of these policies together have to be inflationary over the medium term. There's just no two ways. Introducing tariffs is by definition inflationary, and in addition, causing supply chains to be redesigned along kind of lines that are politically acceptable to you as Donald Trump or the American people or whatever it is, by definition will be inflationary, because the reason that the supply chains are as they are is because they are the lowest cost way of producing the things that America needs. So any deviation from that will always be expensive. And then, in addition to which, just overstimulating economies tends to be inflationary. And, I think we can all agree that a 6.5% budget deficit constitutes overstimulation. Of course, I suppose it's eminently possible that you could get a very dramatic slowdown in the US economy as a result of the macroeconomic uncertainty that's happening. And of course, that would bring inflation down, but that brings inflation down in a way that's pretty unsatisfactory. You get a recession and deficits tend to blow out during recessions, not sort themselves out. So yes, I definitely see a risk to inflation. And I see kind of all elements of that 3+3+3 plan look pretty unlikely.
Now, it is fair to say, of course, that people like you, and I guess me too, of course, but people like you have been worried about the size of the US deficit for quite a long time. It predates Trump. And you could, I guess, put together an argument that says that actually it's one of the reasons why we've got Trump in the first place. So you could make an argument that basically, if you have been concerned about the risk of the debt buildup, not just in America, but around the world, consistently over many years, that perhaps what Trump is doing, he's just bringing forward the moment of truth, if you like, the Minsky moment, perhaps, if I can use a technical phrase, when everything that has been going on since the global financial crisis actually runs into some kind of wall. Do you think that is a significant risk? In other words, how are we going to get out of this problem? How is the world going to get out of this particular problem, which has been looming even without the additional paraffin that Trump is putting on the fire, so to speak?
Yeah, and by the way, I mean, in some respects, you're right that the path was pretty hideous beforehand. And one of the things that's worth noting is that I believe I'm right in saying that when the CBO initially scored Trump's budget proposals, for technical reasons to do with their political mandate, they didn't score the potential revenue benefits of tariffs. And so it's actually quite possible that in aggregate, the big, beautiful bill, as I believe it's called, being put in front of Congress, will not raise the deficit materially above the benchmark that was already there. However, we should point out that what was already there was, by any ordinary standards, truly horrendous. So it's not obvious that the big, beautiful bill that's being put before Congress will actually make the fiscal path any worse than it already was. But we should remember that that path was pretty extraordinary. I don't know if I've mentioned this to you before, but even if I have done, I think it's worth reminding ourselves that using the CBO's long-term budget forecast, by 2030, 100% of federal tax receipts will go on mandatory expenditure. So that's things like Social Security, Medicare, Medicaid, and interest payments. And the entire discretionary budget will be deficit financed. Now, discretionary sounds like things that are, discretionary and therefore optional. I'm not really sure that you and I would call them optional. It's stuff like the Department of Defense and building roads and stuff like that, which I think, we'd all think was pretty much a central function of what government is there to do. So how does it play out? I think there's a very decent possibility, probability that we see a major kind of fiscal crisis and essentially that will emerge in the bond market with the bond vigilantes saying they don't like it. I think it is also true that both the Federal Reserve and the Treasury between them have got quite a lot of tools at their disposal to tackle that. So you could see the yield curve steepen very dramatically. And then at some point, we will then see the Federal Reserve start reinstating QE and buying long bonds. And remember, of course, that the Federal Reserve has got a three-part mandate, and one of those mandates is to have moderate long-term interest rates, I think it is, or something like that. And equally, the Treasury can just stop issuing at the long end. And we're seeing Scott Bessent's been making some comments over the last couple of days that are kind of consistent with all of that. So I think that a crisis in the bond market is reasonably probable, followed by some concerted action by fiscal and monetary authorities. And then we're probably into a kind of financial repression, inflationary era to deal with the consequences of all of that.
Right. And I know some people are even talking about the possibility of capital controls and all those sort of things, which are not, on the whole, very good for us. Well, let's bring back then to what investors can do, what you're doing about all this. Obviously, one theme that we've heard a lot of is, given all that's going on, that people are at the margin migrating a little bit away from US assets, including the dollar. Have you been doing the same in your exposure? I think you have been increasing your exposure to sterling at the expense of the dollar. Is that right? Or is that just the market doing it for you?
No, you're absolutely right. We have been doing that. We did some ahead of Liberation Day. We had a couple of opportune moments in April when sterling was particularly weak to do a bit more, and then we've done some since. And perhaps one way of thinking about it, and all of this has come from our index-linked bond portfolio. I guess, why do we hold US TIPS, or why have we held US TIPS, which are American inflation-linked bonds? essentially we have always felt and continue to think that index-linked bonds are the best sort of hedge for a portfolio of equities, or at least the best long-only hedge for a portfolio of equities. And then second, for most of the last 10 years, real yields in the US have been so much higher than in the UK and Europe and the rest of the world. And then third, that the US dollar has always tended to pick up a bid in the time of crisis. Well, let's look at each of those three legs of that investment thesis. The first one still holds. The second, actually, real yields in the UK have risen very dramatically over the last 12 months, such that they're now essentially comparable with US TIPS. It's not a great deal to choose. And then the third is, do you expect that defensive behavior of the dollar? And the answer to that is clearly recently that hasn't been the case. And therefore that leg of the stool is challenged. So all of that has meant that it seems much more sensible to us to move towards owning a lot more sterling assets, because we can do that with much less risk, we hope.
Does that mean that you become a fan of the current Labour government and the Chancellor and what they're doing, their approach, or is it just a question of relative advantages given your mandate?
I think it would be hard to say that we're fans of what the Labour government are doing at present. I think it's also fair to say that they've been dealt a pretty horrible hand. And yes, I feel that they box themselves into some political corners unnecessarily, but I'm not really sure what I would have been doing were I to be in their shoes. And thankfully, probably for everybody, I'm not. But yes, I think that's right, that somebody used the expression the other day, being the prettiest horse in the glue factory. And I wouldn't quite go that far about sterling in the UK bond market, but at least from a sterling-based investor, it's not an unattractive nag.
And just on the point of the bonds and sterling and so on, in terms of your asset allocation, because obviously you do run this defensive mandate, if you like, looking for positive real returns, you obviously switching something into index linked in the UK and so on for the reasons you've given. But you're keeping your duration or your interest rate risk, if you like, pretty short, right? That's still the case. You're not thinking that any sort of long-term bond yield movement is going to be making you money in the short term, at least.
Absolutely. And so, as ever, we're kind of motivated by fear and greed. The greed is that the real yields, both in the UK and the US, are very attractive. The fear is that there are fiscal pressures both in the UK and the US. I think they are slightly different. In absolute terms, they're greater in the US, they're smaller in the UK. The flip side is that I think the UK is somewhat less in control of its destiny, both in the sense that we've got very little fiscal headroom. Second, that nobody really needs to own UK assets. And so therefore they tend to trade in sympathy with other global assets. And so if there's a crisis in the US bond market, you're kidding yourself if you think the UK comes out of that unscathed. So the way that we're doing it is that we are running reasonable duration. So our UK index linked portfolio has probably got about 8-year duration at present. But we are also really piling up what we call dry powder, which is our very short-dated instruments, so that the overall interest rate risk that we're taking is, if anything, going down on the portfolio.
Right. Okay. I get that. And then I just must throw in a quick question here because this always comes up when we talk to you and others who follow a sort of similar sort of strategy to you. You haven't had a lot of gold in the portfolio.
No, we
And your
haven't.
colleague Peter Spiller says that he's been restraining you younger types from owning more gold. Is that still a mild source of regret? It's obviously performed extremely well over the last 5 years. What do you feel about it in the current environment?
Well, exactly. You always regret not owning things that have gone up a great deal recently. And certainly I can understand why people want to own gold at the moment. I think it's also true that, relatively speaking, it's very easy for our investors to buy gold if they want to. You know, they can buy an ETF and we can't really add anything to that. Whereas we do genuinely think that we've got some expertise in inflation-linked bonds. So that's part of the story. Where you are concerned about inflation, we do just think that inflation-linked bonds are a much better hedge for inflation than gold. And then the fundamental thing about gold is just that it's really, really hard to value. So taking a couple of things that might be moving the gold market right at the moment, you know, on the one hand, it's central bank buying from, say, Asian central banks. Well, that's something that's really opaque. So we can't really see what's going on there. So the demand side is very difficult. The supply side, similarly, presumably these high prices mean that a whole bunch of mines that were not productive previously are now become economic. And so that means that new supply comes into the market. How all of those things play out with each other is frankly really difficult to work out.
So if you can't analyze it, it's taking some risk that you can't get a firm hold on, if you like.
I think that's very fair, yes.
You are listening to a Moneymakers podcast. We are an independent research and publishing venture and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. Let's look at the investment trust. Obviously, by your standards, the last few years have been relatively disappointing, I think, in terms of the returns that the trust has delivered. You had a better year last year in terms of performance. You outrun inflation. And over 5 years, it's not been quite so good. And one factor behind that has been the fact that the shares have been trading at a small discount and you've been buying out quite a lot of shares as opposed to being at a premium before that. I'd like to ask you about that, if I may. As I say, you bought back a lot of shares. I think the share count I was looking at this morning has come down by about a third, maybe nearly a third over the last couple of years.
That sounds credible. I haven't checked it in a while myself, to be honest, but yeah.
So you're sticking, obviously, to your mantra that you will defend a zero discount, basically, and continue to go on doing that until you get back to a premium. Have you been disappointed by the fact that there is still this sort of selling pressure? And how do you account for that?
Just on the performance point, you're right to say that it's not been fantastic. So the NAV total return, and obviously that's the thing that we can control. We can't control what the share price does. It's been 4.9% compound over 5 years. 10 years, it's 5.3. And so over that 10-year period, we've outstripped inflation by about 2.3% per annum, which is not stellar, but it's, I think, satisfactory. And especially in the context of we've been in, I think, the biggest bear market in bonds in history. And as a defensive fund, we own a lot of bonds. And so that's a pretty big headwind. But as to the discount control policy and buying back shares, we are 100% committed to it. And of course, more importantly, the board are 100% committed to it. And I guess there's two reasons for that. The first is that there's just no better allocation of capital than buying our portfolio on a 2% discount. That just is so wonderfully accretive. If you like your portfolio at 100, you definitely like it at 98. And then the second thing is that this is our shareholders' money. And if our shareholders want their money back, they shall have it back. Have we been disappointed that that hasn't turned around? Sure, it'd be nice to be at a premium and be issuing, but I think it's safe to say that all, I guess you'd call them alternative managers. And so whether that might be hedge funds like Bevan Howard or defensive funds that are slightly different to us, but similar like Ruffer or infrastructure, all of these sectors have seen money flowing out of them. And, that'll just take some time to work through.
I'd like to ask you just briefly about the investment trust sector as a whole, because obviously you're also well known and have been for many years because you do invest in investment trusts. That's one way in which you get your equity exposure, your risk exposure. And we know that there's been an awful lot going on in the investment trust sector over the last 3-4 years, and discounts have become widespread. In fact, there's only about, I think, fewer than 20 trusts actually trading at par or better. And I think you've been very active in pointing out that boards need to take discounts seriously, which I guess is another reason why you need to do it yourself, because you couldn't be accused of not doing what you're preaching to others. And you've taken advantage of one or two opportunities there. What is your reflection on the way that the investment trust sector has reacted to the various threats, the higher interest rates, the widening discounts, the arrival of activists, and so on? Would you say that boards have been doing enough or that they should be doing more?
So I think I'd probably divide my answers into two counts. So there'd be the conventional equity investment trusts and then the alternatives. I think it's fair to say that, of course, there are always areas that can be improved upon. And of course, we, as you know, are very puritanical about this. And so we're always asking for absolutely the best. But you'd have to say that a lot of boards of a lot of conventional equity investment trusts have been doing the right thing. So, for instance, I saw that there was a statement today that came out from JP Morgan Emerging Markets, and the board are dissatisfied with the current discount, and they're going to dramatically increase the pace of buybacks. Similarly, we've seen that Smithson, for instance, has bought back, I think, over 25% of its share capital in the last 12 months, or sort of there or thereabouts. So, in lots of instances, you'd have to say that boards are really doing their best to try and get a grip of these things. I think we've been more disappointed with the alternative sector, where the boards have taken much longer to kind of accept that they're in a new reality. We felt that the new reality was pretty clear, and that it was likely to persist for some time, that it wasn't a blip, or at the very least that you needed to behave as if it wasn't going to be a blip, let's put it that way. And so I think that's where we've had a greater level of frustration.
Just on another issue, I just like to throw at you on the future investment trusts. A lot of people now are starting to talk about the competitive threat from active ETFs and so on. And now you invest in a couple of ETFs yourself, but they're not necessarily active ones. You want a FTSE 100 ETF, for example, but you also have a JP Morgan Japan ETF. So what is your thinking about how serious a threat that investment trust boards should be thinking that active ETFs might be?
I suppose I'd almost turn it around and say there is no reason that an investment trust can't behave like an active ETF. I mean, in the sense, you could say that Capital Gearing Trust with its zero discount model is pretty close to an active ETF. That's to say that people can buy and sell shares at something very close to NAV in essentially unlimited size. So I think that, yes, it is narrowly construed, it's a threat, but I think the boards who show sufficient vision will recognize that it's an opportunity in the sense that they can do the same thing as that.
Indeed, and that's perhaps how they should be thinking about it. I would agree with you about that. Have been known to be involved in some activist activity yourself. We've seen, obviously, Saba Capital cutting a swathe through parts of the sector, and you put some money into and some help in changing the board at PRS REIT, for example. That's been publicly said. And you've also backed this new vehicle, Achilles Investment Trust. Obviously, it doesn't show up in your reports because they could be quite small holdings, but have you been increasing or not increasing your activism, if you like, or nudging boards to do more? How would you describe your approach to that at the moment? Has it been sort of top of mind, or has it just been rather at the margin?
I would say it's very, very front of mind. And I think there's probably a number of management teams and boards that are sick of the sight of me and sick of the points that I repeatedly make to them about the virtues of what I judge to be a more rational capital allocation policy. So, yeah, we're spending a lot of time. And, it's really simple. You take a vehicle that's trading on, say, a 25% discount, and for every pound of earnings that their companies generate that they retain, they turn that into 75p. Conversely, for every pound of earnings that's generated by their companies that they use to buy back shares, they turn that into £1.33. And that's as near as makes no difference, a 50% difference. And so I will continue banging that drum until I'm blue in the face. And hopefully some boards will respond. But you're right that there's kind of lots of ways in which it's happening. So there's the Achilles approach, which tends to be marshalling a group of like-minded and frustrated shareholders, and then perhaps, if necessary, requisitioning a board, or perhaps it not being necessary. And then there's the sort of more gentle approach, which is just sitting down with chairmen and chairwomen of boards and talking about what we think they should be doing and everything in between.
It's been interesting to me, at least, the way that the boards of the investment trusts who've been targeted by Saba have responded to that. And they basically effectively seem to be striking deals now with Saba after the kind of big bang approach didn't produce the results Saba was hoping for, as far as one can tell. But do you have a particular view? I mean, apart from buybacks, which obviously, as you say, have very clear-cut advantages, but may not be so easy to do, certainly in alternative space. What are your thoughts about the relative attractions of other methods? So, for example, tender offers or conditional tenders, all the range of things that we've seen tried. Do you think tender offers are a useful way of trying to deal with the issue?
Yeah. So I think it's definitely right to say that our approach, which is to have a zero discount policy which operates in essentially unlimited size at something very close to NAV, will not work for all trusts. It works for us because we've got a very liquid portfolio. And we would argue that people with very liquid portfolios should do something like what we're doing. But I think it's also important to just recognize that the most important thing that boards should do is just keep the promises that they've made to their shareholders. So if they say that they're going to defend a 5% discount, then they jolly well ought to do that. I think that if you take trusts that have periodic tenders, so good examples would be Mobius Investment Trust, Polarcap Financials, BlackRock Frontiers. I think that's a very simple, clearly understandable mechanism, which means that shareholders will periodically get liquidity at something very close to NAV. And that seems fantastic. I'm not sure that conditional tenders are a brilliant solution. That said, they create opportunities for people like us. So, I don't want them to entirely disappear. But if I were a director of a company, I'm not sure it would be the first thing that I would reach for in my toolkit.
Coming back to the trust itself then, so you didn't quite accept my categorization as disappointing. Well, mildly disappointing, you said. And 2% real is better than 0% real, and a lot better than people who didn't have any real at all. So how would you describe, as it were, the outlook? So when you go along to potential investors and you make your case, what do you say to them about the potential for returns as well as the potential for risk management? What's your kind of pitch at the moment in today's market?
Thank you. Let's start with the risk management part, because I think that's really important. So I think that the MSCI world in sterling terms, from peak to trough, and I think the peak was sort of the middle of February and the trough was sort of the middle of April, was down a little over 18%. Our NAV, I think over our peak to trough NAV, which wasn't quite coincident, but over roughly the same time horizon, was down about 3.5. So we were meaningfully not participating with the downside. I've been particularly pleased with how the portfolio performed, given that over that period, long bond yields were rising and the dollar was weak, and we have overseas currency exposure. So when you put all of those together, it's kind of the perfect storm for us, and yet the performance held up pretty well. So that's kind of on the risk side of things. On the return side of things, our 10-year returns of 2.3 ahead of inflation, that's not where we want to be. Our returns have been about 5% ahead of inflation since the start of this century. But as we are geared up at the moment, because of the very high valuations that we believe are the case for US equities at the moment, and two, the very high levels of risk, and we've talked about it as it relates to the bond market, but kind of general macro uncertainty causes us to be defensive. So when we put all of that together, we are in defensive posture. And so I think those sorts of returns of 2 to 3 real, 2 to 3% ahead of inflation is what we're trying to achieve. And then our hope, of course, is that opportunities present themselves, presumably in the form of equity markets falling or bond yields rising very dramatically, that we can add risk to the portfolio and then be more ambitious in our return targets and head up more towards the sort of inflation plus 4 to 5 rather than inflation plus 2 to 3.
Right. And I guess to do that, though, you need potential shareholders to have the kind of time frame to see that play out, shall we say? Because obviously one of the things you hear, obviously, about yourself and about the other defensive trusts out there is that, well, we haven't lived through a great bull market and you've only participated in to a certain extent. So this could take time or it could all happen tomorrow. Would that be how you would describe it?
Absolutely. I think that's fair. I think it's probably fair also that we don't think that the opportunity cost of being defensive is terribly high. So there was a chart in the FT yesterday from Martin Wolf, which compared the inverse of the CAPE ratio, the cyclically adjusted PE ratio, and that stands at about, I think, 2.8% today. And then conversely, long tips are yielding about 2.6. Now, I'm not going to say that the difference between those two is a true measure of the equity risk premium, but certainly the relationship between those two things over time kind of gives you some sense as to how much value you're getting by taking equity risk. And that is at the lowest it has been since, I think, about 2005 at the moment. So
It's not a great precedent. Anyway, let's put it that way.
let's put it that way.
It's not a great precedent for the equity market, that's for sure. Of course, the markets could be wrong. They often are. I mean, the bond market does get things wrong as well. But I think what you're saying is that there is a potential mismatch which should be troubling people perhaps a bit more than they have been troubled by it.
I think that's a very, very fair summary. And why has that come about? We've been in this extraordinary era when earnings have been fantastic in the US for the last decade. And I think that people's natural heuristic, and I totally get it, is to extrapolate that into the future. And whereas I look at a world of tariffs and of genuine uncertainty, which is then going to mean that people are going to reduce their capex intentions and all the rest of it. And so I find it hard to believe that earnings can continue to grow as quickly as they have done in the past.
Unless you factor in some remarkable numbers around AI and what it's going to do to productivity and economic growth and everything else. But I guess you're a little bit skeptical about that.
I would say, yes, I am a little skeptical about that. But it is worth pointing out that in the meantime, while we're in, should we call it an AI boom, that, of course, is wonderful for earnings because, as it were, if we simplify it, that you've got the hyperscalers, Google, Meta, Amazon, and Microsoft are spending vast amounts of money on data centers and NVIDIA chips and all the rest of it. And that is expenses that they are capitalizing. And then that is somebody else's revenue and income. So it's wonderful for earnings in the short term. Of course, if it turns out that those investments don't generate the returns that are hoped for, then there'll be large write-downs to come in the future.
I mean, lots of other things we could talk about, Chris, but I think that brings us to the end of this always interesting conversation. We haven't talked about the risk of wars and geopolitics and all the rest of it, but they would probably play into your worldview, I think, quite comfortably. So thank you very much. It's been fascinating to talk to you, as always. That was Chris Clothier, the Co-Chief Investment Officer of CG Asset Management, which manages the capital gearing investment trust, which sits in the flexible investment sector and has an ambition to deliver positive real returns over virtually every year in aspiration.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.